Good afternoon, ladies and gentlemen. I'm Megan Olson with the Investment Advisor Association, and I welcome you to our webinar, Preparing for Post-Pandemic, What's Different, What's Not. During the webinar, all participants will be in a listen-only mode. You are encouraged to submit questions to the speakers at any time during the webinar by typing them through the chat feature. Only the speakers will see your questions. As a reminder, today's webinar is being recorded June 24th, 2020. I would now like to turn the presentation over to our moderator, Karen Barr, IAA President and CEO. Karen?
Thanks, Megan. And welcome to our session on M&A in the investment advisor space. As Megan noted, it's M&A post-pandemic, but we will also discuss M&A during pandemic. It does seem to be continuing on. We'll discuss what's different in the current environment and what isn't, and what the advisor community should be thinking about right now. I am very pleased to be joined by three experts on this subject. Let me introduce them briefly. John Stern is a partner at Berkshire Global Advisors, which provides M&A and strategic advice. John co-leads the firm's investment management advisory practice. Molly Bernard is a managing director with Focus Financial Partners. She is responsible for business development and acquisition activities. Rick Adler is founder of Red Arrow Capital, a strategic consulting practice serving investment and wealth management firms. And Rick, I'm pleased to say, is also on the IAA Board of Governors. Instead of the usual walk through the deck format, we are going to have a conversation here today. And I'd encourage you to ask questions through the chat function of our experts here. We don't have slides, but we did send around with your confirmation email a link to the handout, the latest report by Berkshire Global Advisors. It contains insightful observations and data related to both the asset management and wealth management space. John, Molly, Rick, let's start by discussing your big picture observations about M&A in the current environment. And let's start with you, John. What are you seeing out there?
Sure, thanks, Karen. Pleased to be here. First observation is that after any economic crisis, there is certainly, at a minimum, some short-term disruption of deal activity and pricing. But there's a big difference between how M&A responds to different crises. Just to refresh everyone's memory, and I think everyone's old enough to remember 08 and 09, that was dominated by a disruption to the financial services industry, and M&A activity came to a halt for a period of time and then rebounded mainly due to divestitures that were required by banks globally and insurance companies in order to shore up their capital. The industry itself of investment management and wealth management was demographically quite attractive at that time, and this was a temporary issue, and as the economy recovered, M&A activity recovered. I think the big difference today is what's happened to the industry over that last 10 or so years, from the increase of passive investing, fee pressure, and growth in alternatives and wealth management. And I think it's really these trends that will push M&A activity going forward from here. And of course, I had a little different opinion in the middle of March when we all thought the market was, going to go to zero again and really impact things. And now today, where the market is broadly back to within 10 or 15% of where it is. So I think as we go through the discussion, we can talk about the ebb and flow of activity in this particular crisis. And I think at the end of the day, as most of these businesses are employee-owned, long-term equity succession and the evolution of the business and the challenges of operating an independent firm will be the driver in the future. Thank you.
Thanks, John. Molly, let's turn to you. What are your observations?
Sure. So, so it's clearly been, the last 3+ months have definitely been unprecedented in multiple aspects. What we're really seeing, especially across our partnership and in the industry, is, over the last few months, the main priority for many firms was really around how to best serve your clients, as well as employees, and then position your firm for future growth when the markets stabilize. So what we've seen is that M&A in general has certainly taken a backseat from a prioritization perspective for many, while running the business really has been a priority in making sure that all of the needs of the business are addressed. So, what we saw across the partnership at Focus is, across our partnership, there's 65 partners and, approximately 3,500 employees that moved into a remote working environment. And many of our partners now are in this return to work phase, which in many cases can be a lot more challenging than the actual moving to a remote working environment, especially given various state rules and regulations around that. So, we've spent, and our partners have spent a lot of time, working through various areas of their businesses during this time. Things like remote working preparation, different business continuity plans and exercising them, cybersecurity, tools for remote working, flexible working policies, reopening plans, as I mentioned before, and then other areas which are more M&A and growth oriented, including, business development best practices, especially during this time. It's actually a great opportunity to grow your business and engage with clients, as well as things like talent management, and various other employee-related issues. So shifting gears on the M&A side of things, what we're finding is, and from conversations as well with various, recruiters and bankers in the industry, that investors remain very bullish in the space, and as do we. The times like these prove and support the need for financial advice, and more importantly, the need for fiduciary financial advice. And so quality businesses with a sticky client base are very much still coveted and are in high demand, particularly given a low yield environment. So, what we're seeing is that there's a continued strong interest in the space, and that's included from, not just the RIA aggregators, but also to private equity-backed firms, and then other external sources of capital like insurance companies and different types of family offices that are interested in growth in this space. So while there's certainly been, and I think there's industry statistics to show this even from Fidelity, a decrease, in actual M&A activity and transition of assets, investors are certainly very interested in the space. And so what we expect is that once we adjust to the new normal, we'll likely find a nice uptick in M&A activity. And to be honest, already in the last 4 weeks or so, as the health crisis has been subsided a bit in certain geographies, specifically in the northeastern area, there certainly has been an uptick in interest in M&A activity. And so we would expect that as long as things continue and the conditions get better over time as we adjust to this new normal, we would anticipate seeing more activity, particularly in the fourth quarter and then into the new year, into 2021.
Thanks, Molly. And Rick, let's back clean up with you here.
Thanks, Karen, and thanks everyone for joining this afternoon. Molly, I'm going to make one comment to something you just made, which was the idea here that before I get into my comments about private equity and the banks and everyone being very excited about investing in the space. I guess because I've been in this space a bit longer than many people, not too much longer, John, than you, but I've been there a little bit longer. I was involved really when PE, which had been very, very much involved. We were out fundraising and converting capital, the firm that I had started back in the early 90s. And in 1999, we hired a very well-known investment bank to go raise capital. And at the time, we did not have .com in our name, and it was impossible. So the idea here that people are really pursuing this industry and really think it's a tremendous opportunity. I agree. I'm totally in agreement there. And right now there is flush. The real question really is, will that money always stay there? And that really begs the whole question. And again, you guys have both, the two of you have both raised it, which is we've been here before, right? You know, the tech bubble really started in 1999 when, you know, if you didn't have .com, it continued through 2000, and then 9/11 hit. And really, so that there was that whole period of time when, you know, for about 3 years where really not, if people were just afraid, so they pulled back. And obviously, as you said, you know, if you look at the time, John, you were very active and I was very active, and Molly, you know, focus was too, is that he was getting started, you know, very, very active. And these events, these external events, whether it is the tech bubble, whether it's really the Great Recession of 08, 09, they pass. And people, you know, my gut reaction is people's half-life of memory is very, very short. So, you know, things will continue to go on. The other piece is that, let me talk about what the sellers are thinking. My experience has always been that if you talk to most people who manage money, they don't use market timing as their investment strategy. That being said, I find many people truly market time the sale of their business. And this activity here, you know, this activity, this downturn is going to push people again, my belief, to rethinking about, well, I'm going to live forever. I don't need to sell. Do I really want to go through, you know, an 08, 09 again, which was really dramatic? And obviously, Molly, as you said, and John, as you said, you know, we've had a great recovery here, you know, this V-shaped recovery, except for today, I'm looking at the screen above me, the market's, you know, it's in general, people have come back. So everyone who said I'm on the fence, you know, it'll be very, very interesting to see what really happens. So I guess, you know, I'm going to be very consistent with the two of you. Uncertainty is going to delay things, but it's not going to stop it. Karen?
John, just picking up on what Rick said here. He semi agree with you, but is it really different this time or not?
Look, I think what's different is the industry. And I look back and say in past crises, the dominant form of investment management was the traditional investment manager. Wealth managers were some private banks and some small RIAs that had 300 or 500 million dollars under management. There were a few big alternatives firms, but not nearly as many today. And so what's happened in the last 10 years is the traditional investment management business is under severe challenge from passive managers and from alternative managers who are taking wallet share from those traditional managers in terms of equity and fixed income and being reallocated to real estate, private credit, infrastructure, et cetera. Wealth management businesses have grown enormously as demographics have led to such an increase in AUM, whereas the institutional business has gone the other way with defined benefit plans and others declining. Lastly, you also have an enormous amount of additional assets that used to be managed by banks and insurance companies that's managed by private markets managers today. So I think the main difference is what's different this time is that segmentation. Back in 08 and 09 and further back, a lot of these businesses seem to trade in the same manner and the same kind of demand. Today, what you will just see is, in my view, is an exacerbation of the trends we've seen. So I think there will be limited activity in the traditional long-only equity and fixed income space. I think wealth management will continue to be very active because there's still so much money going into the buyers of those businesses, and the demographics of those businesses are so attractive. And on the private markets or alternative side, I think as institutions, high net worth individuals, and even retail customers allocate more and more to those products in search of yield again, as rates are going to be back down to zero. Those businesses will also see a lot of activity. And I caveat that with, I also think there's going to be, some of them will be challenged because credit issues will, ripple through the sector. It can't not do that with 40 million people unemployed for a period of time. So I see a very segmented approach to how M&A will go forward, with some areas pretty much continuing as if they did with no impact from COVID, and others being slowed down because of that, as well as just some short-term hold on a lot of activity as people get their footings and get used to working remotely, et cetera. But we can talk more about that.
Absolutely. Molly, any final word on that? Is this different, not different?
Yeah, so, I would say that, I wouldn't say major differences, but there's definitely been an evolution in the industry. Back to what John had said, the trend towards diversification of your business model, in particular around, the type of services that you can offer to clients, has been a trend that we've been seeing for multiple years. So, the typical model of just investment management only, there's clearly been a transition in the industry to a more comprehensive financial planning led business, which obviously in many cases leads a much higher kind of valuation and deeper look from investors. But, I would say that the current time, especially with COVID and working from home, people and entrepreneurs have had a lot more time to reflect. And that time of reflection, in many cases, is resulting in the entrepreneur and founders of these businesses saying, you know what, the future world, the world that we're going to be operating in, we're going to need more to offer to our clients. We're going to need more services, more capabilities, in particular, technology, marketing, and then other things like investments. ESG obviously is a big one these days, especially given current events, and other types of services that will help strengthen the business, in particular in times like these. So those types of conversations have been going on for strongly for the last month or so. But one thing that's unique here is because of the quick rebound in the market, while valuations may be, kind of similar to what they were, I think the motive to actually transact has increased a bit because of the realization of all of these trends that have been a bit accelerated by the current environment. So that's kind of my view on that.
Well, Molly, actually, you just touched on a question that we just got through the chat. Let's go to that, and that is a very simple question in some ways. Have valuations gone down in this environment? And certainly not surprising that we got that question. John, why don't we start with you?
Again, being repetitive here, I think it matters by segment, and broadly, it's a little too early to tell exactly. But I would argue that in the private markets, alternative sectors where most managers are paid on committed capital or invested capital, their revenues and EBITDAs have held up. The growth prospects are arguably what they were before, and that valuations have held up pretty well there and will hold up there. I think in other sectors like the traditional space, a lot will depend on the market and whether it taketh or giveth away, but there will be some pressure on valuation and structure. And I think you cannot talk about valuation without talking about structure. Because ultimately, virtually every one of these deals will have an upfront component and a contingent component. And I think in both the traditional and maybe in the wealth management sector, you will see a trend towards a little less upfront and more contingent over time. and some type of protections if the businesses rebound. So I think that all the long-term drivers of growth, which is what leads to the multiple, are fairly similar. People don't expect COVID to last forever. But I think there will be some challenges and some structuring done in the interim to bridge any bid-ask spreads.
Yeah, I would definitely agree with John on that one. It's not so much the pricing; it's clearly the structure. You know, that's what we've seen in the past. Getting back, whenever you have any dislocations, people are trying to protect what they're buying, which is they're buying a revenue stream, they're buying a cash flow stream, and if that cash flow stream has been impinged by some temporary event, there's typically a way to structure around it, and I think that's probably what would occur.
Molly, any thought on that? You mentioned that you hadn't seen valuations change.
Yeah, I think in many cases it's a little too early to tell, especially given that many, in particular RIAs, bill based on market performance, so based on where the asset levels are, right? So depending on the type of recovery, and obviously, given we took a big dip, but then, worked our way back towards historical levels, not quite there yet. There hasn't been, because it's been such a short period, there hasn't been a huge change, but, to Rick's point, there have been conversations and transactions we're working on around structural considerations, especially given that you might have a bad quarter, or you may have a high quarter that's not indicative of what the future may look like. So there's a lot of conversations around structural considerations on how the purchase price is structured.
Molly, just staying with you here for a minute, given the pandemic and the uncertainty, what have buyers added to their list for due diligence?
Good question. So I think we at Focus specifically are pretty robust in our due diligence process. We basically unturn every stone. So our standard ask for information, I don't think we'd be asking for anything more. But what I could say that, from a due diligence perspective, we'll spend, considerable time on and really additional focus are going to be certain areas around, one, cybersecurity, and obviously regulatory compliance area, ensuring that, these firms have the appropriate capabilities to operate in an environment like we're, currently in, a fully remote environment. So that will obviously be another area of focus that we've always looked at, but certainly an area that will continue to be, I think, a heightened area of focus for many investors. We specifically do a third-party review and cybersecurity assessment every time we do a deal on every prospect. Obviously at Focus, we're pretty deep in that area, but I would expect that other investors would, if they weren't doing that, would definitely want to be doing that going forward. From a business perspective, areas that, we would expect other investors to continue focusing on are going to be around understanding client relationships, deeper stickiness of clients, understanding management team structure and kind of ability to manage the business, so quality of team. All of these are normal due diligence items, but probably will be a little bit of a deeper dive through the due diligence process. And then importantly, business development functionality. So the ability to, grow the business in a remote fashion. So different types of events, different types of strategies to engage with existing and potential prospect clients. We across the partnership have quite a bit of diversity in how our partners approach that. But that will obviously be very important in times like these to be able to continue growing the business. Thanks,
Molly. And Rick, how would you prepare your clients for this kind of due diligence?
It's really interesting to me because one of the keys for me, and Molly, I agree with you, all the systems work and the regulatory review and all of that is really important. But to me, as a buyer and as I'm working with my clients today, a lot of it really relates to the people issues. I always believed, I might have started out as an investment banker and I could always, obviously, the financial engineering side of it is important, but it could always be achieved. At least I always thought that we could achieve that. it's more important to me on some of the financial issues. And I think that's going to be one of the biggest challenges is how do people, either as a buyer or a seller, how do you convince people that the culture, the alignment of all the people who you are trying to bring into the fold, how is that really functioning in this environment of working offsite? And frankly, how do you really get a chance to sit down in front of someone, really understand what are the big people issues that are going on inside the firm? One of the, and the way I always did things, ultimately it came down, the success wasn't so much, the business had to have really, great core strengths. I mean, otherwise you wouldn't make that investment to begin with. But the big wins were when the people were really aligned, and the big losses and the big mistakes I might have made were always because I didn't understand some of the people issues that were so more pervasive in the organization. And right now, that's going to be a very tough task for a buyer and a seller to prove or to at least demonstrate the integrity of all the people issues.
John?
Yeah, I would echo a couple of things Molly and Rick noted. I think the sort of business development distribution in this new world is going to be critically important to understand. There are people who have strong relationships with consultants, or they get clients from their golf club or whatever it is. I think a review of how the new normal, as the phrase was used earlier, will impact business development and growth. And additionally, I think everyone needs to look at performance and how did they perform in this crisis, and what kind of impact is that going to have on future development. And in a bull market where everyone goes up essentially and does what they're supposed to every year, it's much easier to underwrite. When there's a shock to the system, it becomes a little more difficult to underwrite that. So I think those are the areas. And I think lastly, sort of product and strategy relevance, particularly for the investment managers on the call. We're going to be, just when rates had started to go up again and people were changing how they invested, we're now down to a zero rate environment. And does that impact the attractiveness and demand for the firm's strategies?
Thanks, John. We are getting some more questions on due diligence as we're discussing due diligence. And one of them is, are buyers requiring quality of earnings reviews as part of the due diligence process?
Let me take that. I think we always have, right? Any buyer always does. John, you don't agree?
Yeah, I would just say, the sort of official private equity firms or private equity backed firms typically bring in, E&Y or someone else to do a very official report. In my experience, strategics haven't made that type of requirement. They're comfortable analyzing it themselves and don't need the cover that the PE firms need from that. But, they're going to be taking a hard look at where everyone is and evaluating it.
I guess having been on both sides of that, both PE as well strategic, I would guess one of the things that all strategics would like to do is really, one of the reasons why they're strategic to begin with is they're trying to put process around what has historically not been, some of these smaller firms which are not perhaps as process driven. So the idea of looking really in depth at, whether it's, what is the growth model, what is the distribution model, what is, what are there one-offs inside the income statement that is really driven the growth of the firm. And that's the quality of earnings review that I know that we would look at. Molly, I'm sure you have the same thing.
Yeah, I would say from a focus perspective, we always perform quality of earnings reviews. We don't hire external consultants or accounting firms for that because we actually do all of our M&A execution outside of the support of external compliance and cyber review. We do that all in-house through a combination of our business team and our finance team, and so have resources dedicated specifically for the due diligence review. And then members of our team, including folks like myself, worked in the field of due diligence. So I worked at PwC in their transaction services group, so did it as a profession. So our team is fully staffed to do that as part of our due diligence review. But absolutely, we always perform a quality of earnings review on a target before we finalize the numbers.
Thanks, Molly. And one more question before we move on. We got a question from the audience. Do you think that we will see more money allocated to pay to stay for the professionals? John?
I don't think COVID necessarily is going to impact this. As Rick noted, these transactions are typically about the people and making sure the right people and the drivers of the business are properly incented and aligned going forward. And I think buyers very seriously look at that exercise on every deal, from looking about where the consideration's going to go, to incentive comp going forward. I think, this pay to stay as a real separate point has typically been done when large firms are selling or there's a divestiture and they need to keep people. But I think it's just part of the broader plan that buyers and sellers need to agree on.
Thanks.
Yeah.
Sorry, go ahead, Molly.
Yeah, I would just say I fully agree with that, with what John just said. We at Focus, obviously, people are the most important asset of this business, right? So in any transaction, if there's key professionals, as part of our due diligence process and deal structuring process, we want to ensure that those people are incentivized and motivated to stay behind and be part of the post transaction firm. So that's already always addressed in a transaction. So I don't think anything really changes going forward. The key employees are always going to be important and need to be considered in the overall deal.
And I totally agree with that. That's always been number one.
So let's turn, and we've touched a little bit on this, let's turn to the attributes that buyers have historically valued most highly and whether that's changed given recent developments. And let's start with you, Molly.
Sure. So definitely, there's quite a few attributes that buyers look at as being the primary or most attractive components. I would say I don't think there's been a huge change in what buyers look at from quality attributes, but ultimately growth is a big one. So the sources of growth, the culture around growth in a firm, as well as the processes and procedures that the firm uses to essentially execute on their growth strategy. So for without a doubt, that's definitely going to be one of the most important attributes that you look at, because that essentially does also impact valuation. Other attributes that we keep top of mind when we're reviewing a firm to assess the quality of the firm, as I mentioned before, we'll look at things like a diversified service model. So outside of investment management, what else does this firm offer to its clients to ensure stickiness? People, obviously, again, mentioning people being important, but human capital is a huge part of our review. So quality of the management team, including, the leadership team, as well as the quality of the advisors and the capabilities of the advisors. Other things we look at, we do operational due diligence. So we'll look at the firm's infrastructure, technology, back office capabilities, cyber security capabilities. And then in some cases, brand or local presence and reputation is something that, we look to. Now, obviously the RIA industry is pretty much a cottage industry, but there are certain larger firms that, especially local, that do have brand and regional presence. And then, I think the last piece is always, at Focus, compliance is 1, 2, and 3. So the compliance environment and processes, procedures that are in place are going to be a very important aspect to, an attribute that we're looking for a new partner firm.
Thanks, Molly. John, comments on the attributes that you're looking for?
Sure. I would just say, sort of from maybe a little bit more from the investment management perspective, it's really about investment capability and process, the types of strategies people have, and acquirers in this space are looking to get a capability that they believe they can leverage through their distribution network for the most part. Other factors are looking at client base or distribution channel diversification. And, I'd say back to the people, I'm not sure the right word for the opposite of key man risk is breadth of the team and making sure that it's not a 1 or a 2 person show. And we've talked a lot to the IAA roundtables in the past about the value of equity being owned more broadly in a business and other signals to buyers about the value of the key employees. And I think those are all attributes in addition to the ones Molly mentioned.
Molly mentioned growth as a key attribute that buyers look to. What about buyers who are kind of slow and steady wins the race? Really, maybe they're not focused on accelerated growth. How do they put their best foot forward? If growth is not their primary driver. John, I'll start with you on that.
Well, look, I think, again, buyers are looking to fill gaps, and a firm they look at might not be that fast growing, but they might have the either investment management capability or the market position in a geography or other things to grow with the resources and help of the buyer. At the end of the day, it also will just impact the valuation. And those with slower growth on their own will not get the same type of valuation, particularly on an upfront basis. I think we've talked about that a lot at the IAA roundtables about the need to grow for a variety of reasons. Firms that don't grow are probably also have a harder time retaining talent and other things. So an internal focus on growth of some type, whether you've been able to achieve it at all times is another story, but it is important, and a willingness to grow the business with the partner.
I would just say it's kind of different strokes for
right, lifestyle practice or
there's a lot of businesses out there where frankly whether they were lifestyle businesses, did we know they were totally lifestyle businesses when we first bought them or not? That's what they became, and from a longevity standpoint and from a long-term perspective, they were tremendous financial investments that we had made. But were they the growth-oriented businesses that all of us would like to acquire? Probably not at the end of the day, but they were very, very successful financial investments. So I guess a lot really depends on the type of buyer. I mean, John and Molly, you both represent, John, you represent a lot of different buyers out there. And as you said, sometimes they're just trying to fill a niche or a geography or a channel that was not out there. At the other time, it's in particular when I look at kind of a tuck-in acquisition for someone who's really looking for, I need to find either it's an individual or I'm in one city and I hear of something that's occurring, 50 miles down the road, and it's a tuck-in that makes a lot of sense. I mean, is quite as concerned about whether they're growing at the same rate that the core business is growing? Probably not. As long as the people are right and the culture is right and the fit's right. So, that makes some more sense.
I do think it gets back to valuation because Rick is right. There's, particularly in the alternative space, there's a number of permanent capital investors such as Dial and Peters Hill and others that are effectively yield investors. So they're not as concerned necessarily about the growth as they are at getting the right type of attractive and stable return that their underlying investors are demanding of them.
Correct.
Yeah. The one thing I'll say is there's a lot of lifestyle businesses in this industry. And so, a lifestyle business isn't necessarily a bad business. It goes back to, some investors are cash flow investors and, you can invest in a lifestyle business and it makes a really nice annuity stream, right? But ultimately, if the business doesn't have any type of new business development, it will die over time. And so one thing that we look at is if it is more of a lifestyle business and it's maybe a merger for one of our partners, you know, our direct partners, lifestyle business doesn't exactly fit the profile, but it could be a good merger for a partner, whether it be a new geography or a capability that that lifestyle business has that a partner firm may not have. And importantly, with lifestyle businesses, it's really all about the expectations of what happens post-transaction and having agreement on expectations as to what does the combined firms look like, and does the entrepreneur or the seller of the firm, you know, what is their attitude and openness around introducing new ideas, whether it be new services, whether it be participating in business development activities, or allowing the firm, you know, the firm that they merge with to take over that process for them. And so, you know, in the end of the day, it's all about managing expectations. And for the seller of the lifestyle business, I think it's important for them to think through what are they, you know, willing to essentially agree to, you know, to essentially make that merger work as it pertains to, you know, creating a synergistic combination. So those are the things that I would think about if I were running more of a lifestyle business.
Thank you all for those perspectives. Let's turn now to the financial impact of the pandemic and what the parties to a transaction, you know, how are they going to address the financial impact of the pandemic, and what financial metrics should sellers highlight or strive to ensure they have to ensure a fair price? And John, we'll start with you on that.
Sure. I think, and I was not a math major, but it is the metric times the multiple that it is the absolute value. So there's two aspects of it from a pure, you know, valuation perspective, and then as we talked about, it's the structuring. And so, you know, and certainly in the crisis in 08 and 09, the EBITDA and revenue numbers were down dramatically, and on divestitures, the multiple was down dramatically, and the absolute value was down a very significant amount. It's really, as again, a little too early to tell. The market, at least the broad markets in equity, have largely rebounded. Fixed income markets are being, you know, propped up by the Fed and other activities. So the actual revenues and EBITDAs are probably not down a huge amount today. The question is about prospects and how that impacts valuation going forward. And prospects are, you know, twofold. It's net new business, and it's what is the market going to do. And I think certainly buyers are probably going to lower their underwriting for market appreciation over the next several years. And so my suspicion is, in general, the absolute valuation a buyer will have has gone down and will go down somewhat, and that sellers will react by asking for protection on the upside, that if the markets do rebound more or the markets go up more than expected, that they can sort of be made whole to what they would have gotten pre-COVID. So I think, you know, again, the deals we've worked on that are primarily in the private market space have retained their valuation because the demographics of those businesses are still very attractive and are probably enhanced because of where interest rates are. But I think this will evolve over time, and a lot, as always, depends on the individual characteristics of the firm. Did they have and do they have growth in terms of net flows? That's the purest view of how the firm is doing, not taking out the market. So I'm a little all over the place here, but I think it'll be challenging, and there'll be a little more deal making that will need to be done in the next 3 to 6 to 9 months to get these deals done.
Thanks, John. And Molly, what structural changes from your perspective will buyers, you know, typically modify in this kind of environment?
Well, certainly, you know, 2 months ago might be a different response than today. So it's kind of a little bit of a, let's see how the next couple months look to decide, you know, final structure depending on where the market is. But to John's point, the one thing that, you know, we always look at very deeply, but even more so now, is going back to growth of the firm being dependent on market appreciation. So revenues linked to market versus revenues linked to true client growth. So in the end of the day, the things that, you know, will be, we continue to be laser focused on is growth, you know, the ability to grow, bring in new assets, new clients to the firm, and the ability to retain those clients. So stickiness of clients and quality of clients, and growth of the firm, and from a, you know, revenue and client perspective. So, you know, all of our transactions are generally linked to that to begin with. But you know, those are the things that during these times, if I were a seller and I was saying, what are the things I should be monitoring to kind of demonstrate the value and quality of my business, those would be, you know, from a financial perspective, those will be metrics that come out as an indication of the quality of the essential assets in the business. So that's where, you know, how we think about it right now.
Thanks, Molly. And Rick, turning to you, how would you evaluate debt, taking on debt during the pandemic? You know, there's been a lot of talk about the PPP and other loans.
Yes, there has.
What should folks consider there?
So it's interesting. You know, I actually, you know, I currently sit, at one point I've sat on over 20 IAA boards, and I'm currently sitting on 3. And the PPP situation came up on all 3 of them. And it was a fascinating conversation. I think, you know, as we've all said, you know, the fast recovery of this market and the billing cycles of our businesses, even if firms were billing daily, if they're mutual fund companies, or if they're billing, you know, quarterly in advance or quarterly in arrears, where we sit today looks a whole lot better than where we were sitting on March 23rd. But when PPP first came out, which was right after at the lowest end of the market, I think firms were properly concerned about how deep this was going to go. So in my opinion, knowing that, you know, people applied for this money and perhaps even received the money made total sense. Because it was the right business decision. In particular, if some of the firms on the wealth side who didn't have other avenues of capital, either they don't retain cash in their books, or they really hadn't gone out to banks and even had bank lines. Then you roll forward 2 or 3 weeks ahead of that, the markets come bouncing back. They realize, you know, the end of the world is not here. And then you start hearing things about, well, if you took money, you have to disclose this perhaps on your ADV. That was a huge red flag for a lot of people, because ultimately it said, what's the reputation risk I have if I had to take this money and did not have, you know, I'm supposedly a financial steward for your individual money or your business's money, and we didn't have enough resources to handle this own. So it became kind of a negative. And my view here is that I don't think the reputation risk has fully been discovered yet. You know, Karen, you and I, we've had conversations about, will this all get disclosed? And, you know, Secretary Mnuchin has said, you know, firms over a certain size, it will be disclosed. The biggest problem on reputation risk, which is the big key for me, it's not so much the financial side. If they needed the money, if the program was a good one, you should take it. It's the financial risk going forward. In hindsight, 2 years from now, will there be that will be their black mark on the firm's reputation because they had to take money during this pandemic?
John, what's your take on
I'm probably not as concerned with Rick. I think it's I think most people probably who've taken it actually really didn't need it, but it was available as an insurance policy in case things really went bad, and that people will give that consideration in terms of how they look at it. I think there's obviously been some backlash in general about the types of firms that take this and whether a firm that has recurring revenue really should have been eligible for the program and how people view that, but not quite as concerned as Ray.
And not concerned from a debt perspective. In other words, it's
Oh, yeah, the debt, that all washes out. That's,
agree.
you know, they
Whether it's
put
forgiven or
money
not.
in,
right.
firms are still making money. They'll be, you know, I don't think it's going to change valuation. It'll be factored in if it's either
So,
have to be paid back or not if they borrowed money. But they borrowed money, they really needed it.
Well, let's pivot now to something that I know all three of you want to talk about. And we've touched on it a little bit earlier, and that's culture, right? How important is the culture for M&A? And I'll add another spin to it. How the heck do you evaluate it in a remote environment? So Molly, let me start with you.
Yeah, so culture is very, very important in a firm and obviously in our due diligence process. It is part of our due diligence process to ensure that the firms that we're investing in, you know, align to not just Focus, but also our other partners who are, you know, part of the same network. Culture generally is one of the biggest success factors that essentially allows our partners and other firms in the industry to transition from, you know, fully in the office to remote to going back into the office in whatever form that looks like. And many of our partners are looking at different iterations of this. And it's what allows for the connectivity in the organization. So, you know, the firms with bad, you know, quote unquote, bad cultures or, you know, kind of poor cultural connectivity are those that find a lot of stress in their organization during times like these, and in particular find a pretty big lull in employee morale. We actually did a whole webinar that we had, I think I led it about 2 weeks ago, just on employee engagement, especially in times like this. And firms with a strong culture really think through deeply what it takes to engage your employees, to give them opportunities to stay connected, and are very committed to that. And it shows significantly, and it shows not just internally, but it also shows to clients. So, you know, and also very, very important, you know, when we look across, you know, culture specifically, you know, in the context of what's been going on from a society perspective these days, diversity inclusion is actually part of the culture of a firm. And that's, you know, something that's really important to us at Focus as well as to our partners. And so it's not just around being able to work together, it's about promoting an environment where people feel their voices are heard, where they feel they're included. You know, those attributes and behaviors do cascade down from leadership all the way into the group, into the team. So as it pertains to due diligence and doing deals and how do you assess that, one thing I will say is it's not easy, right? The good news from a Focus perspective is most firms that we're engaging with, whether it be virtual or in person, a lot of these firms we've had relationships with for a very long period of time. So it's not that we're blindly going into a process without having known the key players, the leadership team. But, you know, employee due diligence, which is part of what we do as our due diligence process, is much more difficult when you're doing a Zoom conference call to get a good feel for, you know, the employees and how they work together. So that is definitely a challenge for an investor. You know, but like I said, from a Focus perspective, many of the firms that we are in dialogue with are firms that we've known for quite some time.
Thanks, Molly. Rick, your thoughts on culture?
I 100% agree with what Molly was just saying. It is a critical component. It's a critical component to success. It's a critical, but again, think about it. You know, when these businesses, you know, I like to paraphrase, you know, the real estate business, you know, our industry, it's the people, it's the people, it's the people, instead of, you know, the location. It's people who were able to raise the money to begin with. It's people who are taking care of the clients, and it's the people who you are investing in the future. So the idea here about, you know, what that culture is that made the firm successful to begin with is really critically important. I agree with you, Molly. I think the toughest thing is for those of us who've known these firms for a long period of time, the process is it's kind of seamless. It's much more difficult for someone who you're just coming up to speed with, and you don't really know them. And that, to me, one of the things I've always said about this process is it's not your day job, right? This isn't, selling your business isn't your day job, and buying a business, except the three of us on here, which is our day jobs. But it's not everyone's day job. And the analysis of the strength of the organization, so much of it really comes from our discussions with people, not just looking at what the numbers are. And that's going to make it very difficult. That is one aspect of what's different. I think that's probably going to be the toughest challenge all of us have going forward, is how do we really get our hands around what is that culture within the organization if it's all we're doing it is through Zoom calls.
John, too.
Yeah, look, I agree with all of these points. I think at the end of the day, the real challenge in the environment is how do you judge culture? Rick's last point is really relevant. Largely we're doing Zoom meetings, and the buyer's spending a bunch of time with the top 2 or 3 people in the firm. And the real question is, do those people really exemplify the whole culture of the firm, or are there different cultures within the firm, et cetera? And it's why people like to kick the tires and go to an office and see how it's set up. Does it appear collegial, or is everyone in their own office? And seeing how younger people interact with their bosses at these smaller firms tells a lot. And so I think some of that, secondary part of the culture discovery is going to be more difficult today than it was 6 months ago.
And I would say, John, it's going to be very hard to find that red X on a Zoom call. That's going to show up post close, unfortunately. So.
Right. Well, given all of this, and we just have a few minutes left, I want to ask what prospective buyers and sellers should be doing to best position themselves for what lies ahead. John, let's start with you here.
Wow, this is the money question. Look, I think the main thing that most people are doing is, it's all about the business, the investment and service performance, and in this environment, taking care of employees, many of whom, will have questions about coming back to work. So I think in general, just taking care of the business, making sure you can do the best you can to retain clients. I think in this environment, everyone understands getting new business is a little more difficult, but retaining clients is probably the best sign that you're still doing what you're supposed to be doing and doing it well, and continuing to think of your employee roster, ownership, other things like you would normally do to prepare in the best way if you're going to entertain a sale in the future. And I think that employee side of it and ownership and how you would, don't use COVID as an excuse for not making progress on all of those things. You need to keep sort of slogging it out and making progress on all of that to position yourself when the environment is a little more certain to execute on a sale process, if that's what you want to do.
Thanks, John. Molly, what is your perspective on that question?
Yeah, so in addition to what John said, I would say 3 more things. One is take note of what buyers are valuing, what they're interested in, and what demands a premium valuation. Which, back to my earlier points, I think in these days growth will be very important. So dedicating time to think through your strategy there. 2, definitely do your homework. So as a seller, there's a lot of different types of investors in the space. And as a seller, you should understand the differences between different types of investors, how their model works, what the outcome of the transaction will be, and what works for you from an objective perspective. And then the third one, which we just talked about, is culture. It matters, right? So if you don't find the right partner and it's a bad fit, no matter what you get paid, it'll never be worth it. So, you know, never underestimate the value of cultural fit.
Thanks, Molly. And since baseball is potentially back, we'll have Rick back clean up again.
At the end, because I think you both hit it right on. To me, it's really awareness. Really, be aware of, you know, why you're successful, who you are, what you want to be, and where do you want to go. As you know, Molly, I think you brought it up earlier. You know, you have time to reflect. People should reflect on what's the core strengths of the organization, and be able to really tell that story in a succinct fashion, and make sure that story is really spread through the organization. If you talk to 5 different people in a company and they all give you the same, you know, elevator speech, then you really know that somehow this has really been they are self-aware. That's really key to me.
Well, thank you. And we are exactly out of time, but I want to thank all. This went really quickly. Always a lot to talk about. I want to thank John, Molly, and Rick for a terrific conversation. And thanks all of you for being with us today. Feel free to reach out if you have any other questions about this topic or any other topics that you think we should discuss in future sessions. So thank you all and have a great afternoon.
Thanks everybody.
Everyone.
Bye.
Bye.
Bye.